All right, so I think this is sort of a fairly small probability event. First of all, I'm speaking at two conferences on the same day, and especially the first conference, I was the first speaker, and the last conference, I was the last speaker. So thank you for staying for this late. So today, what I'm trying to talk about is probably less about NLP, more about using machine learning, and how can we use machine learning to understand the news and news content. So it's a little different from some of our previous research papers. So in some of our previous research papers, we talk about probably more on the NLP side. One of them is more about referencing using NLPs to analyze companies' regulatory findings. In that research, and again, some of the work was done by Lauren Cohen from Harvard, look at the language changes, but we're kind of going far beyond this. The second one is probably even more interesting. We call tone at the top, quantifying management presentations. In that research was more looking at using NLPs to analyze management presentations and how we can understand going beyond the sort of a typical sentiment, more around how can we understand management psychology. So do management teams have the tendency of over-exaggerating their performance? Or even more so, is the management team dominated by certain egocentric personalities? I'm not saying about Tesla, but you can sort of think about sort of the same philosophy. In this specific research, we want to talk about using news sentiment, which you probably remember, again, some of you. We wrote our first news sentiment research back in 2009. I was at a different firm. I'll show you the implications of after publications, right? So this probably echoes some of research about is academic research really killing alpha? You can sort of see that some of the empirical research, empirical evidence. So this is sort of the main paper we're going to reference for most of the day. The application is predominantly in the equity world. We have a sort of a related research by looking at global macro. So we also look at the Pareto's data before. I want to mention that as well. In this specific research, the background data we sourced from RibbImpact. We've been using RibbImpact's data for probably a little bit over a decade. We also tested a wide range of other news sentiment related data sources. So there's some similarities. Roughly speaking, RibbImpact was used to be predominantly processing Dow Jones news. These days probably cover most of the mainstream news, social medias, and related kind of stories. Basically covering almost all of the public traded companies globally. So this research will be looking at global, although the contents itself can be more English language dominated. So you're going to see the global or the regional implications when we're going beyond the English language or where English language is not the main language for the specific regions. In the database, everything is tagged into a millisecond. We do have a sentiment scores, but the most important one that we focus on in this specific research was about the interaction of the news, attentions, but also corporate events. Right? So the vast majority of the news that we're tracking, or the vast majority of the social media comments at the single company level are associated with a corporate event. Right? So the most common one being revenue, earnings announcements. That account for probably about over 90% of the news. They're definitely market moving events, but you don't necessarily need a news sentiment or NLP to understand the news language related to earnings announcements. We have a sell-side analyst such as myself, and this is our job by reading, understanding corporate communications. So the news related, sort of an event related to news, to earnings announcements count for the vast majority. They do have some alpha in it, but that alpha is probably not what we quite require because we can get the same thing from analyst sentiment or earnings revisions, a type of kind of a signals. Right, so we want to understand is what is really the interaction between news, market reactions, so the sort of behavior biases, and the interaction with corporate events. So do investors reacting to different kind of events in the same way? As you can probably imagine, it's quite different. Right, so earnings related news tend to get a lot of market attention, but we're kind of looking for the less frequent news the market probably don't pay a lot of attention to. All right. So this is sort of a quick summary about a simple, in the industry way, we call it backtesting. So does news sentiment itself leading to any abnormal returns? So this is probably sort of a starting point. We don't really use a sort of a return forecast. We're starting from something we call rank IC. This is essentially just saying is in a cross-sectional context, what is the correlation between our signal, in this case is RibbImpact, pre-computed news sentiment versus future stock returns. In this case, about 1 month ahead of stock returns. If your signal has a perfect predict power of every single stock returns, you should have a correlation of about 100%, and vice versa. If you have a completely opposite effect, you should have a correlation of negative 100%. In reality, nothing comes to that close. So the simple rule of thumb in the industry is for US equities, if you have IC or correlation around 5%, that will be considered extraordinary or quite strong, especially for the US market. We care more about the risk adjusted, so how stable is that relationship between the signal versus future stock returns. You can see the correlation is actually fairly modest, around 1% or so not spectacular, but it's fairly consistent over time until around 2012-ish. If you look at accumulated performance, so this is more like if you're building a sort of a long-short hedge portfolios, how the signal performs over time, we're just buying the companies with the best positive sentiment and selling the companies with the most negative sentiments. And you can sort of see is again, the signal initially performed quite well and kind of plateaued around 2012 and afterwards. And keep in mind is our first paper published around 2009, and we did a few follow-up papers when we were at Deutsche Bank. So I'm not saying our research really caused that signal decay, but as the signal becoming widely known in the industry, you do see the decay over time. Right, so 10 years ago, we can probably say news sentiment was very novel. It's probably being considered as alternative data, especially with the professors from Columbia who kind of copied the ideas, industry copied the ideas over the years. We definitely seeing the signal starting to decay. Nowadays, I don't even know we can say news sentiment is a sort of alternative data anymore because it's being widely known and used in industry. So we're definitely seeing at the monthly frequency, there isn't that much of alpha in the past couple of years anymore. So the purpose of this research is how do we understand or how do we squeeze probably a little bit more juice from news sentiment data? All right. So probably won't spend too much time here. I was saying is news contents on its own is fairly high turnover. After considering for transaction cost, will become even worse. So roughly speaking, for the rest of the research, we mostly stick with around aggregating news over the past 3 months. And that's basically where we're getting the best predict power. At the same time, we're also seeing we have a more modest turnover. All right, so now we're getting into the more interesting part, which is how the news can be broken down by different kind of corporate events. Right, so you can see the vast majority of the news are related to earnings, revenue, but of course, not that interesting. We care more about the product and services related. We'll probably care lots about the labor issues. The credit ratings we're going to talk about in a second, legals and litigations. You can further define the events into more and more refined categories. But still, you kind of seeing is earnings and revenue related tend to completely dominate the contents. You also seeing is on average, right? So obviously, you're seeing a wide variations of legal, right? So legal related cases, on average, you tend to be more negative, especially if you actually work for Deutsche Bank for 7 years, like myself. You kind of remember the legal news typically is bad news. The average is very negative, but you see there's a very wide variations. On the other hand, you can see is right? So explorations is probably mostly related to oil and gas, finding a new reserve. On average, tend to be more positive. The variation also tend to be far smaller. Earnings related tend to be more in the middle, right? So half of the companies beating earnings, actually more than half. The half of the company missing earnings. So on average, the contents is half positive, half negative. So you can sort of see there's a wide variations, but you're also seeing there's definitely some sort of a standing out. Stock picks, right? So on average, we know sell-side analysts tend to be more positive, more bullish. So the average view tend to be more like a positive news. On the other side, credit ratings, right? So we care far more about credit rating downgrades. Right? So upgrade is not that spectacular. If a company being upgraded from AA to AAA, who cares? If a company being downgraded from investment grade to junk bond, that's where you're seeing lots of tremendous market attention. All right. So these are the sort of pre-computed news sentiment scores by Ravenpack, a number of them. One of them is slightly different from the rest. Is really about called NIP. This is related to, rather than related to the future company performance, this is related to the future company's volatility. You can sort of see is volatility is not exactly negatively correlated with returns, but they kind of have a negative relationship. You're also seeing is earnings generally speaking, generating lots of market volatility. On the other side, partnership is probably less so. Okay, so again, what is a really partnership? Building companies, building joint ventures tend to be not such of a market moving events. So what kind of also seeing is that the sentiment related tend to be positively correlated versus the volatility tend to be more negatively correlated. These are the sort of events are highly correlated, probably give you less of a diversification benefit. On the other side, you can sort of see is the credit ratings, legal cases, they tend to be quite different from the other corporate events and the news coverage. So these are the sort of gold mines that potentially give us more diversification benefit. All right, so let's do a sort of a dry run or test case. We'll just look at some of the common corporate events. This is a fairly simple event backtesting. We just look at the market reactions around plus and minus 60 days or 60 days before corporate events versus 1 year after corporate event. We're also dividing for each corporate event. We're also dividing all the news stories into the positive sentiment. You're kind of seeing the blue line here versus the negative sentiment, which is a red line. Right, so this case shows you the two charts about merger and acquisitions. Right, so the vast majority of M&A transactions, before the deal announced or around the deal announcements, you're typically seeing it's more like a positive news. Right, so positive sentiment tend to dominate a number of cases versus, so the most of the news are related to these blue lines. You're kind of seeing is this market tend to overreact to M&A transactions. There was a big jump, especially for the target companies. Share price on the announcement day, the post-announcement drift is actually negative. Okay, so this is probably fairly well known in the industry, but also in academia, as this market tends to overreact in some cases. You don't necessarily see the same kind of post-announcement drift in the same direction. There's a little bit of a hint for negative news, right? So market underreacting news, right? So for our point of view is we want to build a trading strategy that we buy or selling after we already seen the news, we see the sentiment, what do we do, right? So there's some more counterintuitive thing is buying after we're seeing a positive sentiment is not necessarily working well. We're actually seeing more like a reversal pattern. I think my previous presenter also showed something similar, although that one was more about repackaging news. In this case, we divided news based on corporate event. This one is about share buyback. You kind of see something very different. Is on average, most of the news related to stock buyback tend to be positive news, but they kind of are not really market moving event, right? So a company saying we're going to buy back 1,000 shares, 1 million shares over the next 5 years. It's not really a market moving event. A company tend to do this consecutively over a multiple period of time. You're kind of seeing not necessarily repeated news, but you're kind of seeing a follow-up news. Company wants to make a buyback announcements, they tend to make a similar announcements over a period of time. You kind of seeing is market underreacting news. Actually, even negative news on buyback also leading to positive post-announcement drift. Ownership is mostly related to insider transactions, so insider buying and sellings. Right, so fairly well known as this insider sellings is now very informative. Right, so this mostly related to probably financial needs rather than to any sort of informed transactions. Insider buyings mostly leading to positive sentiment. You do see again a positive post-announcement drift. Right, so rather than manually dividing them based on different kind of news, later on we're going to show you is we want to use a machine learning algorithm to dynamically learn this sort of interaction relationship, and hopefully we're going to see something. We want to see if that machine is smart enough to learn the patterns dynamically over time, and we can generate access returns. I won't spend too much time on the other corporate events, but they kind of follow similar patterns. Right? So this is really about equity analysts, readings, positive readings and negative readings. Again, most of the actions are market reactions really on the announcement day. Market is fairly efficient. We used to say this is you can follow analyst revision used to be a very strong signal. Just buying the company with a positive revisions, selling with the negative revisions was very strong. Many years ago, now it's almost completely arbitraged away. There was a very little post-announcement drift, although it's in the same direction. On the other side, you can see is credit rating is very different. A rating downgrade caused the market crash on the day, but actually market overreact to the bad news. Right, so this is fairly known as once we see a bad news, right, so we sell first, we'll think about it later. But once you see a positive news, you don't have to buy immediately. You're typically waiting for the confirmation. So we're normally seeing some sort of overreaction to bad news, especially the very kind of a market disasters. And we're kind of underreacting to good news. Credit rating upgrade again, right? So it's not really a market moving event. The same thing for earnings guidance is very similar to earnings revisions. Dividends, again, is very similar to buyback and kind of seeing the same kind of patterns. Layoffs and legal issues are, generally speaking, bad news. And again, you kind of seeing is very similar to the previous case on credit rating changes. Market, generally speaking, overreacting to bad news. So these are the sort of rare events. Not so many of them. They tend to be market moving events, and market tend to underreact, tend to overreact to bad news initially, which leading to a sort of a mean reversal patterns. We're going to see a little bit later. We also look at the industry-specific news, right? So these are the ones related to clinical trials, mostly related to biopharma companies. Same-store sales is mostly related to retail companies, hotels. So these are the ones, again, you tend to see very different patterns from the other news event types. They have a very low coverage, right? So there's a trade-off of how much coverage you want to see. Earnings and revenue related is very wide. You have lots of news. The sample size is tremendous. But if you look at the industry-specific, the sample size and the coverage tend to be much smaller, but they also tend to have a higher signal, which is something you have to balance. The second thing we look at was, again, we look at the interaction of the volume, news volume, versus how the market react to the different kind of news, right? So the question is the no news a good news or bad news, right? So that really depends, right? So if you look at on the one extreme, no news or good news, right? So these are typically related to executive appointments, right? So CEO changes, CFO changes, we know on average they tend to be bad news. The more frequent the company change in the top management, the worse it gets, right? So you typically don't want to see anything related to executive announcements. On the other side, you can sort of see is on average, earnings and revenue related tend to be positive news. Market tend to react to lots of announcements. When a company refuses or have late filings, when you don't see a periodic updates on earnings and revenue, they generally speaking tend to be more negative news. Right, so sort of we have three dimensions. One dimension is really about the sentiment. The second dimension is about how market reacting to the news. And the third one is really about corporate events. So we want to build a model trying to put the three dimensions together. So that's sort of a challenge that we're trying to do. The way we build our model is really by using, as I said earlier, is rather than we manually going through every single interactions, which in our opinion suffers some of look-ahead biases. Right, so we already look at all the data. We already know how the market reacting to the news. But of course, 5 and 10 years ago, we did not know that relationship. So in our opinion, once we understand the relationship, building a model, going back in time is really a serious look-ahead bias. Even if you divide your sample into other sample in sample, you still have the same kind of problems. So the way we design this is really about to see is what machine learning algorithms help us to understand this relationship before we actually seeing the data, right? So when you're designing this sort of a machine learning exercises, you can actually doing what in machine learning we call the cross-validation. In finance, we typically call them backtesting. So you kind of think is I'm going to use one period of data to learn whatever patterns you can identify and try to see if that model can predict future returns. Then you keep rolling your data, and then you cover, of course, your machine keep learning from the new patterns, and you want to try to identify the patterns over time. So that changes the sort of a prediction is also being made in a dynamic fashions. In this case, the model is basically trained on a monthly basis. We're kind of using the previous X years of data. Again, what is your size of your own rolling window? The size is one of the hyperparameters you have to tune when you're building your cross-validations. In this case, we try to understand both a linear relationship. In the cases is if the market consistently over or underreacting to a certain type of corporate events, then your linear model will probably capture that relationship fairly well. We also train a nonlinear model. In this case, is using a sort of XGBoost type of relationship. We're trying to predict if the stock will outperform, underperform in the post-announcement periods. In this case, you can use a classification tree type of algorithm to understand any sort of a nonlinear relationships, right? So maybe the market reacting really conditional on attention, right? So if it's a news that market paying lots of attention to, This again, when the market over and react will probably be very different from another news on smaller companies which may not getting the same sort of attention from the market. This chart is a little hard to see. Again, all these basic things is these are some of the input variables. Some of them are related to the contents or the counts of the news. This is sort of proxy for the market attention. Some of the other ones are related to the sentiment. Some of them pre-computed by Ravenpack. Some of them are computed by us. We're going to show examples as is. If we're going through these complicated exercises, does it add any incremental predictive power compared to if we're just using off-the-shelf sort of a sentiment signals from the data vendor in this case. You can also see the mixture of these different kinds of pre-built, we call it features in machine learning. For one corporate event, which is legal, this is sort of a rare event, versus revenue news tend to be a large number of observations. The mixture of the news tend to be a little different. Right? So for a very popular news, such as earnings and revenue, you see the news counts tend to be very important. Right? So we need to understand is do we see lots of news for the same company? Does the market paying attention to such news or not? Versus a very rare case, which is about legal events. You're typically getting a market attention regardless if a company is large or small. So you can sort of see the contribution tend to be quite different. The other sort of things we need to balance is again, the blue bar shows you the performance. In this case, it's about predict power future stock returns versus coverage. Right? So in the investment business, we call it breadth. So can we express our views on a large number of stocks? Ideally, we want to have a large positive bars on both. But there's also another dimension, which is how the signals correlated with something we already have, which is typically price momentum, earnings revisions related type of signals. Right, so for example, on the one side, you see earnings related is actually quite informative of future stock returns. We also have a great coverage. Almost every single company will have earnings related news. But on the other side, this is also highly correlated with some of the other signals. So there isn't that much of incremental value we have. On the other side, same store sales, you can see is very strong predictive power, but very low coverage. We only have it for a few hundred companies on a sort of a consistent basis. And this is typically not very well covered, even by the sell side. So you do see the correlation later I will show you is much more modest compared to the more conventional stock selection signals. Right, so you have to make a balance of all the three dimensions. This chart shows you most of the corporate event-based adjusted news. Right, so this is basically using our tool machine learning algorithm, build the signals for a specific corporate event compared to these are the sort of color coding in blue versus some of the pre-built signals from Ravenpack, which is really in red. You see is most corporate event using this complicated exercise, they do seem to provide a much better performance than using the off-the-shelf signals. The next step we want to do is we also want to combine the different kind of corporate events. Some of them with a great coverage, but high correlation with traditional factors. Some of them probably have a low coverage, but nonetheless, they do have a strong predictive powers. We want to combine them all together so we have hopefully the best of both worlds, decent coverage, but also strong predictive power. So we apply the second machine learning algorithm. In this case, is using a ElasticNet, which is a combination of, this is actually just a fancy version to do shrinkage regression. It's a combination of ridge and lasso regressions. It turned out to be a little bit more robust than your simple, typical linear regressions. Then we combine all the typical corporate events. You can sort of see again, some of them tend to be more dominating, shareholder related, which is again not so widely covered. Some of the other ones, so these stats vary between different regions. US versus non-US tend to be very different. This is sort of a simple performance for the US equity market. You do see again is now we do have again hopefully more consistent patterns over time. We don't see sort of as much of a decay anymore. This is sort of a newer version of a model, so we do hope the signal tend to be a little bit persistent over time. You also see the payout patterns for the best rank versus worst rank is that also seem to form a more linear monotonic patterns. So not just coming from small companies, coming from the short side, which may not be able to capture in real life investing. Our performance in the non-US market tend to be even stronger. Right? So especially when we are divided by geographic regions. So US, for example, very strong. You have a large number of stocks. English language, again, is tend to be more dominating. Europe, UK, you tend to see something very similar. On the other side, you do see a smaller market. So Canada, ANZ, so Australia, New Zealand, these markets tend to struggle somewhat. We don't have enough coverage, although English is being the main language. You also see is for the non-English, where English is not the main language, such as China and Japan, the signal also seems to struggle. This again, as of these iterations, we only cover English language. Luckily, this is a model decay profile. So this is again about the predict power for the first month of returns, the second month, the third month, and going forwards. This is not cumulative. You'd also see is this decay seems to be a little bit more modest compared to off-the-shelf signal from a vendor. Lastly, again, is probably the most important one is how is this one compared with your traditional stock selection factors? Are we just building another simple price momentum? Are we really having something a little different? And this chart also quite interesting to show you is this is a model we call a NICE or NICE, depends on if you follow the English or the French version. We like to call it NICE, but we also have most of our clients tend to call it NICE. Either one works. The other sort of two models we call it SPEC and SMAC. These are the ones based on the NLP, based on the company communications, based on the company's regulatory filings. But you sort of see is among the three models, correlation seems to be modest. Our niche model is somewhat correlated with earnings growth and price momentum, but it seems to be more manageable. Combining the three models, actually, given their modest correlation among the three, we do see some, again, meaningful performance improvement. Lastly, what I want to show you is this is probably a better way to differentiate the real performance from the signals into what we call the performance attribution. Right? So we're attributing the active performance of the model into what is attributed to common styles, so value, momentum, versus what we call the residual. This is really sort of a true unique alpha from the signal. You do see is half the performance come from exposures to other value momentum. The other half seems to come from more residual returns, which seems to be, again, quite promising. You're also seeing is it does take a positive loadings on earnings revisions, take a positive loadings on price momentum. Again, no surprisingly, those loadings they do give you some returns, but it's not quite necessary because eventually you probably want to combine your signals together. So those are the ones you probably don't really need. You can neutralize them, but you still have some decent predict power. We're also showing you, again, is in the real life investing, we do have a benchmark model by combining a typical value, momentum, growth. We also show the incremental value by combining the niche with a benchmark model. Again, you do see some incremental performance improvement. All right, so I hope that's sort of a conclude of how we build this model. Again, appreciate you staying this late. With that, we can open up for questions.
Do you have a story? So some of your event types lead to overreaction, others to underreaction. Mm-hmm. Is there any pattern to why some things get underreact, some overreact? Like, is there a unifying theme?
I think the overall theme we're seeing is the significant market moving events such as credit rating downgrades, legal litigation related. The market seems to overreact, especially bad news, right? So bad news on the market moving events, market tend to overreact, right? So layoffs and litigations. On the other side, a small positive news such as dividend announcements, share buybacks, the market tend to underreact, tend to overlook the repeated positive news. It seems to be fairly minor on their own, but collectively speaking, of course, they're starting to make a bigger impact.
When you're talking about credit downgrades, did you see or look for a different effect going from single A to triple B compared to triple B to double B? Because in some cases, when you drop below investment grades, the funds that are forced to sell you are bigger than the ones that may be able to buy you, and you could get different effects.
Yeah, very good comment. We did see a much bigger impact, especially on the announcement day, for the downgrades from investment grade to junk bond. In more recent years, we seem to be seeing just one level above the junk bond also seems to see a much bigger impact. So I guess sort of traditionally companies strive trying to maintain the rating just one level above the junk bond status. So the market gradually learn the lesson learned, seems to react accordingly. The sample size does get smaller as you're trying to refine it.
I was just curious about the Ravenpack scores. These are algorithmic-based scores, but what's their nature? Is it something that's standardized? Is it like, do they use certain heuristics?
I think for Ravenpack data, again, we've been using it for about a decade. We also tried a few other sort of data vendors, including Thomson Reuters and Prattle, again, sitting in the room. I think more or less it's based on something similar. On the one side, is sort of based on the standard academic literatures by doing word counts, or you can do something far more sophisticated. But generally speaking, it's just counting for the number of positive and negative words, taking into account of the grammar structures. That's one approach. The other approach is you kind of training your words and the linguistics by using future stack returns, which kind of causing a forward loop because you're already training algorithm based on the future stock returns. Then you classify whether they're positive or negative, but these are sort of how market reacting to the news. They're becoming even more complicated when you're moving away from company specific into macro news. Right? So a Fed announcements of hiking interest rate is that positive or negative. That really depends on one, what economic cycles we are in, as we heard from the media panel. On the other side is just what asset classes we're talking about. Right? So we're seeing how the equity market react, how the bond market react, how the currency market react is very different. Right? So in the single company space is a little cleaner. You can train the model based on future stock returns, but in the macro space will be more complicated. In the case of Ravenpack, it's a combination of both. So on the one side, they did hire many years ago about these experts, let them to read the news and manually classify. Then you try to learn from that patterns. So this is sort of a one training sample. The other one is they, I believe, they do train a model based on future stock returns. That's why we have a few different kind of pre-built sentiment signals.
Well, thanks for such a comprehensive analysis and really powerful results. My question is that given that you're in the business of providing this information to the market professionals, right? So the fact that more people are using your signal, wouldn't that diminish the usefulness of the signal? So how would you assess, the two sides of the coin?
I think it's definitely true. So on the one side is once a data set is known, once a vendor starting to provide the data, especially once we have a leading academic starting to write research on the topic, and we do see gradually more people adopting the database and the signal probably starting to decay. But we also see on the other side is there is a significant lag, right? So we first published, if you just use our own example, we first published our research on using news back about 10 years ago. It took a long time for investors to embrace ideas and starting to use news data. I think it's probably about 4 or 5 years of delay at the minimum. The cycle is definitely shortened in recent years. I think almost every large asset manager these days has already built a sort of a data science team trying to proactively incorporating, studying alternative data in their investment process. So this again, unfortunately, is more like an arms race. We have the race to find the best ideas and implement it before other investors can do. There is a significant cost of entry. Right? So on the one side, almost none of these data is free. On the other side is you can certainly build in-house, but it's also not free. You have to hire the right people, doing the right things, and until you're getting convinced, right? So there is going to be some delay until we're seeing enough history, enough coverage. But again, eventually, yes, we'll probably get an arbitrage away.
Thank you so much for the presentation. In the one hand, you're looking at the sentiment scores and that as a signal. Mm-hmm. Another element in there is the taxonomy that goes behind it is also being provided by Ravenpack.
Correct.
One of the patterns that we've seen is like hedge funds and other groups are actually creating their own taxonomies, not only looking at their own indexes. Yeah. How do you see those taxonomies affecting this sort of research?
Yeah, so that's sort of an interesting one. Is sort of there's almost like a feedback loop. On the one side, we again, including all the other hedge funds, we build our own NLPs, analyzing languages and trying to see, trying to identify patterns. On the other side, again, surprisingly, we used to talk to only the hedge fund as a sell-side research provider, but we're starting to see more interaction with one is the media. So they want to understand is how their news story is being analyzed by investors. We're also seeing lots of interest from companies themselves. Right? So we never really speak at a company CFO conference until recent years. Right? So company management also want to understand is how their own communication is being analyzed by the street, by investors. I don't know if they have done anything yet, but at least you're kind of starting to see the interest of once the text content is being analyzed by the street and the management or the reporter starting to learn that patterns and trying to do something of the opposite. Right, so I think the central bank announcement is probably a classic example. I'm pretty sure central banks already know their language is being heavily scrutinized manually by computers and by everybody, many people globally.
Okay, well, we can continue the discussion in the reception. So,